Dear students, welcome to the lecture series on financial management. The objective of this lecture is to understand the conceptual framework of financial management, that is, main roles of financial management regarding investment, financing and dividend decisions, then broad concepts regarding profit maximization and wealth maximization, and finally functions of financial manager. What is financial management? It's an area of business management. It is an evolving subject. It aims at judicious use of capital and careful selection of sources of capital. It deals with acquisition and procurement of funds. Reason for meeting the business objectives. So we can say financial management deals with procurement of funds, their effective utilization in business, keeping in mind overall goal of firm. There are two basic aspects of financial management which we have learned from these definitions, that it deals with one, procurement, second, utilization. When we think about procurement of fund, there should be a trade-off between cost and benefit. Cost needs to be identified, that is, minimal cost has to be chosen, risk associated has to be considered, and finally control over the cost. It is well known maxim, higher the risk, higher the profit, but overall scenario of the business has to be kept in mind. Like, if so much risk is taken that my business is going to be a doom, I have to eliminate those risks. I have to trade off between my benefit and risk. This is called procurement of fund. When I go for procuring fund, I will take most judicial decision where my cost is minimum, where my benefits are higher, where my returns can be enhanced. This is the function of a financial manager. Second aspect is utilization of fund. This is very essential. Just procuring of fund is not enough. How do we utilize that fund into our business? Whether we are blocking the entire fund into such assets which are not that productive, or whether we have to bifurcate our cost allocation in such manner that returns enhance. These sort of investment decisions we need to take when we utilize the funds. Utilization of funds, there are two types of decisions taken, long term, short term decisions. So we will elaborate them one by one when we learn them in detail. What is the nature of financial management? It is an indispensable organ of business finance. A business cannot run without financial management. It cannot be kept secluded. It has to be an integral organ of the business itself, because procuring finance, utilizing it, then follow-ups, this is a process which cannot go alone. It has to be hand in hand with the business organization. Now, it's a continuous process because it's not a one-time decision. It's a regular decision. It's evolving day by day. It's not that at special occasions I need to call my financial manager and take a decision. It is also one of the aspects of financial management that on special occasions their demand is higher, but during day-to-day activity also I need to take my financial decisions. In dividend payouts I have to take my financial decisions. So it's a continuous process. Then it's less descriptive and more analytical. It's not a descriptive subject, it's analytical, where I have to use my skills, competence to apply the funds in the most appropriate resources. It's different from accounting function. Accounting deals with the recording of the transaction after it has taken place, while financial management is a pre-hand process. It comes before accounting. Where financial management ends, accounting starts. So it's a broader concept where we need to make the projects, evaluate them, we have to take decisions, then comes the final transaction. It helps the decision of top management. Decision making process becomes easy with the help of financial management, where elaborate reports are prepared, analytical reviews have been done, cash flows, fund flows are prepared to know the short term positions. This way, it's a very crucial part of business. Students, now we will learn about financial functions. There are basically three financial functions. They are the broad categories in which we have classified these functions. They are investment decisions, financing decisions, and thirdly, dividend decision. What is investment decision? Investment decision, when we read, there are certain questions which we need to answer. That is, what is the optimum firm size? What specific assets should be acquired? What assets, if any, should be reduced or eliminated? In a nutshell, it is the analysis of long-term decisions where we have to acquire certain long-term assets. In other words, investment decisions are also called capital budgeting decision, where there are certain decisions which are mutually exclusive. They are accept reject decisions which we need to take applying various techniques of capital budgeting, where a decision is taken that I need to go for this project, I need to purchase this asset, or I need to go for expansion, or I need not to go for expansion. So broadly, investment decision is a decision of acquiring or not acquiring a long-term project or a long-term asset. Second comes financing decision. Financing decision, under this, a manager has to take the decision regarding procurement of fund. When he has a decision regarding procurement of fund, what he'll do? He will find out sources of fund from where he can gather these funds, from equity share capital, from preference share capital, or from debentures or loans. That is, he has to take a decision whether I have to do my financing from my own funds or borrowed funds. Then, when he has so many sources of funds available with him, he has to choose the best alternative out of it, which he can accept using his rationale, and that rationale would be based on minimum cost criteria. The source which will give him the least cost and by which he can enhance his earnings, he will go for that decision. So source of fund needs to be selected on a very rational and judicial basis. He has to find out cost of capital of each element and where the weighted average cost of all those sources comes minimum, and going for that, if increases his EPS or reducing equity increases his EPS, he will follow that mix of capital structure. So it's very important concept that source of finance has to be selected properly. Then once a source of finance is selected, it's very difficult to change it. It should be very flexibly chosen at the time of selecting. Now we have source of finance. Next function under financing decision is to use that source, that is allocation of fund. We can allocate our fund to buy an asset that can be long term. Long term assets means all those fixed assets which will give us benefits or returns over longer period of time. They are plant and machinery, building, and like all other long-term assets. While short-term assets are those assets which can give us the returns in a shorter period. They are mainly concerned with liquidity. Liquidity means that how early I can get back my cash, my money invested. So when I have to utilize my fund, I have to be very sure that I need not to block my entire fund in the long term assets, or I need not waste my working capital in investing in the short term assets. So there should be a trade-off between them. Third important function is dividend decision. Dividend decision is a decision where we need to find out whether we need to pay out the dividend or we need to retain our earnings. Dividend decision is ascertained by a formula. This means it's called a payout formula. How much earnings to retain and how much dividend is to be paid out of retained earnings. There are certain schools of thoughts for dividend decisions. Some says that paying dividend affects the market price of shares, while others are of the view that market price of share remain unaffected by the payment of dividend. There are certain scholars like Jordan and Walter who supports this philosophy that the dividend decision affects the share price of the company, while approach, Moody-Gillani-Miller approach suggests that it does not affect the market price of share. This way, we need to take the dividend decision as per our business requirements. Now, dividends can be of various types. A cash dividend can be there, stock dividend can be there, interim dividends are paid by the company, final dividends are paid. So, there are various ways in which dividends can be paid out. Students, now we will learn a very broad concept called profit maximization. The objective of financial management is either profit maximization or wealth maximization. When we learn the objectives of financial management, we need to learn about these two broad concepts called profit maximization and wealth maximization. What is profit maximization? Profit maximization is considered as the goal of financial management. Maximizing the profit is an implied objective, and therefore it is natural to retain it as the goal of financial management. The profit is regarded as a yardstick for measuring the economic efficiency of any firm. Had all business of the society worked out for maximization of the profit, there would have been efficient, economic and profitable utilization of resources. There had been minimum wastage. In this approach, action that increases profit should be undertaken, and the actions which reduce the profit, we need to avoid those actions. What are the shortcomings of profit maximization? Firstly, it ignores risk. There is a direct relationship between risk and profit. Higher the risk, higher the possibility of profits. If profit maximization is the only goal, risk factor is altogether avoided or ignored. Therefore, finance managers will accept the proposals with which risks are highly associated. That means they enter into risky project in order to earn profit, and that is not exactly certain profit, that's the possible profit. They may enter into a risky transaction and can face losses. So the first shortcoming is ignoring risk factor. Profit maximization's scope is narrow. Profit maximization objective is too narrow. It fails to consider social consideration. Social consideration means various related groups like consumers, government, interest of workers are altogether ignored. So ethical trade practices are not followed as required under profit maximization. And if these factors are ignored, company cannot survive long. It will become a short-sighted policy to go for profit maximization only. As I said, that profit maximization is very short-sighted policy because it works on the cost of both social consideration and ethical values. Profit maximization as an objective is vague, it's ambiguous because it does not clarify which profit it is talking about. Is it the average profit? It is the past profits? Or it is future profits? Or it's net profit? So it's in itself is vague in terms. Lastly, it ignores time value of money, which is most crucial to eliminate risk associated, taking into account the interest rates, etc., which is altogether ignored. It works on accounting profit, which itself is a vague concept in profit maximization theory. With this, we have learned profit maximization. Having understood profit maximization, now students, we will learn what is wealth maximization. The objective of the firm is to maximize its wealth. Wealth means its value. Value of firm means its market price. That is market price of company's common stock. Common stock means its share. So, where the objective of the firm is to maximize its market price, it's called wealth maximization objective. The market price of a share of a company serves as a performance index. Performance index means it's a report card of the firm's progress. It indicates how well the management is doing on behalf of shareholders. On one hand, where profit maximization widens the gap between management and shareholders, wealth maximization works as a coordinator between management and shareholders. Many other factors also affect market price of share at a given point of time. The market price of a share is a function of two factors. Firstly, earning per share, and second is capitalization rate. So, market price per share is computed as earning per share divided by capitalization rate. Therefore, finance manager need to ensure that earning per share are optimum, keeping in view risk and other factors. Wealth maximization decision criteria is also known as value maximization, or net present value maximization. Value maximization is widely accepted as appropriate operational decision criteria for financial management. It removes all those technical limitations of profit maximization criteria. The measure of wealth used in financial management is the economic value or net present value method. Economic value means net present value. It is calculated by discounting the future cash flows using appropriate rate reflecting risk associated with the project. The risk is mitigated by applying discounting rate over the future cash flows to a certain extent, so we can find out the future values in present term by eliminating interest elements using that capitalization rate. This capitalization rate is cut-off rate. It's called cost of capital. And lastly, it possesses three requirements of suitable operational objective of financial course of action. What are these three objectives and how they differ from profit maximization? Firstly, exactness, because it discounts future cash flows and work out present value, while profit maximization profit is vague, ambiguous, whereas wealth maximization's criteria is exact. Next, quality of benefit. The quality of benefit means it provides benefit to both management and shareholders, whereas profit maximization ignores other groups. It ignores social considerations. Lastly, time value of money. Wealth maximization takes into account time value of money, as it is also known as net present value criteria, while profit maximization altogether ignores time value of money, as it takes into account profits. Students, now we end up our session by encapsulating what we learned. We learned about financial functions, that is investment, financing and dividend decisions. We learned about objective of financial management, that is profit maximization and wealth maximization, and comparing the two objectives. And we learned about financial goals. With this, we are ending up our lecture today. Thank you.